First of all, very good morning to all of you. I haven't seen a room this big with this many people in a while. It's been about 3 years since the pandemic started. In fact, I would say I haven't even had meetings with groups of more than 10. So a little bit unnerving to see all these people packed in a room and waiting for me to deliver a keynote speech. But anyway, I'll do my best. First of all, my first Cypher conference, so very excited to be here. Fantastic to hear that we get to see Kapil Dev later in the day. Back in the US, I've been a part of many employee engagement activities, and during many of these things, one of the typical things that will come up is, tell us about your greatest day in your life. And I used to always pick June 25, 1983. Anyone know what that date is? Yeah, that's right. So India won the World Cup that day, right? So for all of us, we identify Kapil Dev with India winning the World Cup. So particularly exciting for me to see that Kapil Dev will be on the agenda later in the day. So very excited to see that. And by the way, Usha, I already found my batch buddy. Not yet. I assume I'm the first one. And I think you said something like a 1 crore prize or something for that.
So then I would be finding my batch buddy, if that was the case. And
okay.
When you find your batch buddy, you need to quickly post it on LinkedIn because that's when it's valid.
Okay. So hopefully I'll do that, and hopefully nobody else is quicker than me in finding that. I couldn't have asked for a better setup for my presentation than Amresh and what he walked us through. It's almost as if he took the AI ML landscape and given his company Genpact that works with a range of clients, he explained as to how AI and ML has evolved into serving clients and making difference in various verticals. What I'm almost going to do is going to actually build on that and show one particular industry, which is financial services, which is what American Express is in, and how the data science as well as AI ML usage landscape has kind of transformed, especially over the course of the last 3 years or so, right? So, it's almost as if Amresh was actually working on his presentation, almost anticipating what I was going to present, because he framed the whole thing as 3 E's, experimentation, expand, and then finally automate. And almost like, if I were to frame my presentation into kind of clean buckets like that, it will be almost the same as what he did, right? And wherever Amresh is, I'm pretty sure he's taking a note saying, like, expand Genpact contract with American Express. So I'm pretty sure he's doing that. We already have a lot of business with them. So anyway, thank you, Amresh, for a good setup. So let's just jump right into it. Okay, that's just me. If you read the second bullet, which pretty much says that I've done every function in credit risk, that's just an embellishment so that you would start thinking, he's going to give out some very important words of wisdom, so I should stick around for the next 30 minutes to listen to him. So if it accomplishes that, I'm very, very happy. So anyway, long experience in the field of credit risk, and I hope to make the presentation interesting for you. So first of all, just a little bit background on who American Express is. I'm pretty sure we are no stranger to anybody, but some facts here are quite relevant to the presentation I'm going to make. So we are a very big company. We have over 100 million customers across the world. We process over 7 billion transactions, so each time you use the card, that's a transaction, and we process over 7 billion of it every year. Those 7 billion transactions converted to $1.4 trillion worth of volume that goes through our systems. Okay? So from a data perspective, that makes us very, very big, right? In fact, we store each and every transaction of those 7 billion transactions in our system, and we use each and every one of those transactions to build our data, models, and analytics, right? So that's a lot of data. And then in order to process that data into intelligence, you need a lot of technologies like AI, ML, as well as the intelligence that comes out of that. We convert that directly into automated actions. right? In fact, I would say 99% of the decisions that we make is completely automated, and there's a small portion of 1% where human intervention comes in. So we are very steeped in the culture of using data and using AI/ML technologies to convert that to intelligence and use that in servicing our customers, right? And we've done quite well. So if you look at the bottom right, JD Power is an award that is handed out every year. And we have won 12 out of the last, I would say, 15 years or so, the #1 position in terms of customer satisfaction. And most of the time when I talk to people about American Express, they always compliment our customer service, which is also heavily driven by data as well as the intelligence that we get out of that, right? So keep that in mind as I go through this. As we were thinking about what to present as part of this keynote, right? Amresh talked about how he looked up GPT-3 in order to figure out his topic for presentation. I did something much more rudimentary than that. I wasn't quite sure what the word keynote meant. Okay, to me, it was literally translated, it is an important message, right? Key, important, note, message. So that's what I literally thought. So I said, let's look it up in the dictionary. So the dictionary actually says the meaning of the word keynote is prevailing tone. That's the meaning you will find in the dictionary. So based on that, I said, okay, let's pick a topic that kind of captures the prevailing tone, right? So based on that is what I am going to present today is our topic. So if I can just move this along. How the landscape of risk has changed over time. And it's a particularly relevant topic at this point in time, simply because just think about the last 2 or 3 years now, right? We are going through this period of enormous change, right? The analogy I would say best represents that is almost, for us, a significant date was March 20, 2020. That's the date when overnight we went from all in the office to all virtual, right? Almost on an overnight basis. And I suppose that's the experience most people have had through this pandemic as well. And if you had asked people, they would have said, you know, virtual working probably will be a reality 10, 15 years from now. And then something like a pandemic comes in, and then overnight you accelerate what was supposed to be happening 10, 15 years from now into something that's happening overnight, right? So in a sense, that's analogous to what I'm going to be talking about today, which is our company, as I pointed out, is very steeped in data and analytics. And a lot of the innovations and transformations that we would have eventually done over a course of time got accelerated and compressed into a very short time frame that is captured by this period through which we've gone through in the last 2-3 years, right? So the pandemic and the changing landscape of risk is asking us to innovate faster and make those changes today rather than take the time of the next 5 or 10 years to do that, right? So that is kind of the story I'm going to try and tell you over the course of the next few minutes, okay? So let's jump right into it. So rewind back to 2019 and what was going on at that point in time, right? So some of these headlines capture what was the prevailing sentiment at that time. So at that time, from a financial industry perspective, somebody working in credit risk, this is what I was looking at, right? And most of the people in our industry were doing the same thing, which is, hey, a recession is due. And at that point, you know, a typical business cycle is about 5-10 years, an expansion followed by a recession. So at that point, since 2008, we've not had a recession. So everybody was anticipating one is due, so it's likely to happen. And then as soon as the recession happens, we knew our losses will go up, right? And we were prepared for that. So we kind of have a recession playbook, which we had used in 2008. And then we said, OK, let's pull that out and dust it off, and then make it ready for handling this next recession that's going to come, right? So that's what we were looking at back in 2019. And then everything changed, right? So there were whispers in late 2019, there's something going on in terms of a pandemic, and it's going to grow bigger. And then it landed on us all of a sudden. As I said, overnight we went to a work-from-home mode, right? So the entire world stopped. Businesses came to a halt, shut down. So at that point, we readjusted our expectations. So we said, it's not going to be any garden-variety recession. We're going to have a recession that could be the mother of all recessions, right? And we kind of significantly increased the expectation we had in terms of the losses we are likely going to get. So that's what we were planning for at that point in time, right? Okay, so with that mindset, then something else happened, which was again unanticipated, which is, and most of my conversation is around the US market because that's where American Express, majority of its business is, even though we are global. So you know what happened, right? So you had the US government flooded the market with a lot of relief. A whole bunch of consumers got a lot of money directly into their bank accounts, right? To the point that many of them even said, you know what, I don't even need to work, I'm quitting. And then you had the great resignation that happened, right? Because people just felt that they're able to kind of get away from work and take some time off, right? So there was a lot of monetary stimulus that was flooded into the market. And then, including the businesses, right? Even on the business side, the government gave them a lot of money just to hold on to the payroll and not lay people off. So these are things that, again, were unanticipated. And as a result, it made a huge impact on our kind of expectation as well. So what happened was, as the government flooded money into people's bank accounts, as well as business bank accounts, what we were expecting before, so we had started with a garden variety recession, higher losses, then we said pandemic, the losses will be much, much higher than we previously anticipated. And what actually happened was a complete opposite of what we were expecting, right? We actually have had, over the course of the last 2-3 years now, the lowest losses that we've ever had in the history of our company, okay? And this is pretty much true for other companies in our space as well. Most of the lending companies are actually having the lowest losses ever that they've had in their history. But it's not over yet, right? So at this point, the US is talking about inflation, which seems to be very persistent, and then there's whispers of stagflation converting into a full-blown recession. So we still don't know what's going to happen. But what it taught us is, as somebody said, I think it was Tim Geithner during the last recession, make use of a crisis, right? It'll be a tragedy if you let a great crisis go to waste, and use that crisis to kind of transform yourself and change yourself as an organization, as a company. And what I'm going to tell you now, what we did is hopefully setting us up well to be able to tackle any other surprises that might come along. And hopefully we also accelerated our innovations and become a better company as a result, right? So let me walk you through what some of those things that we have done are. So this is how our data science and AI/ML landscape has changed over the course of the last 3 years, and probably going to continue to change over the next couple of years, right? So what was the big few things that happened? So these are some of the data challenges. So if you look on the left side, these are the traditional sources that we relied on to make our automated decisions, right? So typically, as you know, credit bureau is a very large and very rich source of information. So typically in a credit bureau, you'll get like one record per customer summarizing the financial history of that customer, right? And that's a big key input into all our models. And then you also must have heard about a FICO score, so that all that information is kind of fed into a FICO score, and that provides you the intelligence of who's going to default on a credit basis versus who's going to be solvent, and so on and so forth. So we relied on that a lot, right? So that took care of 99% of our decisions, right? And then I pointed out that small 1% where humans come in to augment the machines to make decisions, those will be typically high net worth customers, right? Or big businesses where we have to hand out large credit lines. And there we relied on things like a business income statement or a personal net worth statement of a consumer, a financial statement, right? And humans had to typically look at it, extract intelligence, and make those decisions. So what happened was, in this pandemic, as I pointed out, the government flooded the market with relief, right? In fact, to the point also that there were moratoriums in place, allowing people not to make payments on credit card debt, not to make payments on some of the mortgage debt that they had. And at the same time, those things won't get reported to the bureau, and the scores will not change, right? So when something like that happens, where customers are allowed to miss payments, and those pieces of information do not change your credit quality as reflected in the bureau, then that changes the fundamental relationships within our data, right? So the data models and the relationships you had captured and you were using for your decisions, those are fundamentally changed, okay? And even the information, the amount of, the type of intelligence that you were getting out of it, the nature of that fundamentally changes. So what we had to do as a result of that is to kind of look at data differently as well. So rather than looking at aggregated, summarized data, we actually went towards some of the alternative ways of looking at data. So first of all, we said if you have the income or a financial statement of a business, typically what will happen is if I asked a business now to provide their financial statement, they'll give me a financial statement at the end of last year, right? So we are in 2022, they'll give me a financial statement at the end of last year, 2021. Now, when a pandemic happens, that business now doesn't look anything like what they did last year, okay? So those financial statements are useless, right? So I need something that is more recent and reflects the more current state of that business, so that's where bank data comes in. So we said, give me your last month's bank statement. Okay, so that will more reflect the current state of that business. And then we said, aggregate data doesn't work anymore. And we want to look at the raw data, which captures that customer's history trade line by trade line. Because as I said, some of the relationships in the data has changed. Even the FICO score became less powerful than it used to be, and it's a very useful, very powerful score. Not that it's useless, but its power declined. So we had to augment that. We had to come in and fill that space by looking at data differently. So we went down to like trade line level data. And also, it was coincident with a lot of alternative lending also exploding in the market, right? So if you think about an example like buy now, pay later, all that you hear about in the lending market now is buy now, pay later, right? And to the extent that people are even talking about buy now, pay later is kind of displacing a lot of the credit card business even, that it's become so large, right? Companies like Klarna, Firm, et cetera, they've all grown to be very, very big. So all these things happened at the same time. So we had to change the way we were looking at data and how we extract intelligence from it. So 3 big questions that came up out of this, right? One is the reliance on traditional data. Can we rely on it as much as we used to do in the past? The answer was clearly no. So we decided, let's go back to raw data, and I'll show you an example of that. And then how do you extract intelligence out of this raw data in an efficient way, right? So that's where techniques like AI/ML comes in. I've mentioned one here, word-to-vec, word embeddings. Algorithms like NLP had to be brought in to take data that used to be previously very structured. Credit bureau data is very, very structured. But suppose I'm now getting a bank statement. Bank statement is written in some kind of a format that is specific to a bank. And go from bank to bank to bank, the format changes, right? So in order to extract that kind of from that unstructured data intelligence, you will have to apply some kind of state-of-the-art AI/ML techniques, which is what we had to do. And then last but not least, I just pointed out to you how things changed, right? So we were expecting record credit losses, and then overnight, we're getting the lowest losses ever in our history. So that kind of a seismic change, in a very rapid way, also requires us to have our models kind of modify themselves at the same speed, right? Because remember, I'm making decisions on a daily basis. We are making decisions on 7 billion transactions a year. That's a few hundred million even within an hour, right? So in order to get those decisions right, I have to have models that work well all the time, right? And in order to kind of have good prediction, I'll have to have the models change in a very seamless way, in a very automated way. So these are the 3 ways that we fundamentally transformed. So if you think about just the first piece, which is traditional data, so this is what essentially it looked like in a nutshell, right? So we have a huge FICO score that's usually one of the top 5 variables, right? If not the #1 variable in your prediction of credit risk. And then there's a lot of, okay, the slide didn't quite come out right. But anyway, there's a lot of credit history that's captured along with that data. So how many, when did the customer first set up their trade lines? How many trade lines do they have? How much total balances they have? What kind of total payments they are making? So a very aggregated look at the consumer that we get through this source of information, and that is a very key input to our models. And then what we did was we went back to raw data, right? And so when you get a card application, for example, and I pull raw data, I can actually get trade line by trade line data, right? So if you have an American Express card, what did that look like? When did you start on that card? How much balances you have? What's your history of balances, history of payments? So I get that on American Express card. I get that on your Chase card. If you have a mortgage loan, I get that on your mortgage loan. And for each one of them, I have trade line history. So that's the rawest of data you can get. So we went back down to the rawest data. And what that allows us to do is to actually plot out the customer's financial history, right? So as shown in this picture, you can actually track what the customer did over time. So they went and got an auto loan, followed by they applied for a card. So there was an inquiry on the bureau asking for credit. And then maybe on one of the cards, they went from paying it in full every month to starting to revolve and paying interest. Perhaps they missed a payment on the mortgage, right? So if you piece that together, you're actually able to give a time series history of that customer in terms of their financial history. And that gives you a lot of things to extract from that data, right? So what are the events that happened, severity of them, the frequency of the events? What was the sequence of events that happened? Does the sequence mean anything from a potential to default on the credit perspective? The recency of events. Did it happen a long time ago or did it happen recently? So these are all the key things that we can learn from this data. So essentially, we went down to the raw data. And this is kind of what it looks like, right? So when you look at the raw data, there's a lot of different types of data. You've got numeric data, you've got character data, et cetera. So you will have to use more newer techniques to be able to process it. So what we did was we took that input and we started using techniques like recurrent neural network in order to be able to process that into the intelligence we needed in order to make our predictions. So you can take things like words that's contained in that data, and you'd use things like word embeddings, word-to-vec, in order to convert that to intelligence, and then use some kind of a learning logic that allows you to kind of understand what does that sequence of events mean in terms of the potential to credit default. And you get a lot of recurrent neural network attributes out of that. And then finally, we bring in a thing called multi-layer perceptron, like MLP, that combines those RNN attributes into a total prediction score that comes out at the end. Okay? So if you didn't follow all of that, doesn't matter. All it means is we went down to the rawest level of data, used some of the more AI/ML type technologies in order to convert that into scores. And these scores are much better than what we would have done had we relied on the traditional sources of data, which are too aggregated. And the relationships within that data was broken by the fact that there was a lot of external shock imposed on the market. Right? The government came in and changed everything. The government did it for the right reasons, right? Giving moratoriums to people, not having to make payments and not reflected on the credit bureau, all is the right thing to do, but it changes the nature of the data, and therefore we had to come in and adjust for it, right? So that's what we ended up doing. And then continuing on, if you take something like a bank statement, right? So we had to kind of build a technology to figure out how to take that bank statement, and literally people are pulling PDFs of their bank statements and submitting it to us, right? And when they do that, how do you extract the data you need from that in order to make your scores and decisions and so on, right? So we had to build the technology that is able to do that. So you bring in something like optical character recognition to read that PDF, and it could be like a native PDF, or it could be just a scanned document, right? And we have to be able to recognize that. We also have to figure out whether it's tampered with, or is it an authentic data source, et cetera. And then what we did was we read the entire bank statement, converted every line in it, including the top-level summary, how many credits, debits, your beginning, ending balance, et cetera, and all of the transactions that are in detail. And sometimes, if it's a business, for example, and they give you a business bank statement, there's literally 500 lines worth of transactions in it, right? And it takes a few minutes to process that and convert that to data. So what we did was we converted it into readable data, and then once you get readable data, then you apply AI/ML logic to understand what are those transactions, what do they mean, right? In the case of a consumer, it could be an incoming transaction that's a salary deposit, right? Or it could be an outgoing mortgage payment. So can we use AI/ML techniques to kind of recognize what kind of a transaction it is, and then use that data to feed back into your models to predict, right? So that's essentially what we did. We got bank statements, convert that to readable data, use AI/ML to classify the transactions, and this is kind of a virtuous cycle exercise. So you get more and more data, retrain your model, make it better and better, and then finally make some key assessments about that customer, right? What is their risk? If it's a business, what's their revenue? What does their cash flow look like? Are they financially sound or not? So these are the key pieces of derived intelligence. And then there were also some significant changes in terms of behaviors, right? which required us to think about automatically training our models. So here's an example. So this is the trend of the overall business on our cards across the pandemic. And what you see here is that blue line in the middle is the overall spending levels. And what you see is it took a huge fall during the pandemic, right? Quarter 2 2020 is when the GDP of US declined by perhaps the greatest amount since the last depression, the Great Depression back in the 20s, right? So when you look at the blue line of overall spending, we took a steep dive, and then slowly it came back up over time as the economies recovered and the lockdowns ended and businesses opened up. But if you split that overall line into a couple of categories, one is travel and entertainment, and then the rest, which we will call goods and services. There were very different trajectories across these, right? So if you look at travel and entertainment, that almost disappeared, right, during the peak of the pandemic. So we went down by 90+% on travel and entertainment, whereas the goods and services didn't take that much of a hit, and it came back faster to, when you take it above zero line, what it means is it's gone above pre-pandemic, but the travel and entertainment is still below what it used to be pre-pandemic, right? So very different trajectories taken by the different categories of spend, and this matters for our data and our models. The type of spend, whether you're spending it on travel or a retail purchase, et cetera, that's intelligence that's baked into our model. So this kind of big change means our model predictions also go haywire, right? So we have to actually retrain our models in an automatic way to keep in tune with the changes in behaviors which are quite substantial so that our models stay accurate. So what we had to do was we had to redo our algorithms where we said, I need to train our models on the more newer data that is coming in, and then add it on top of the existing base models that we had to get more accurate predictions that can help us navigate through the short term, right? So that's what we had to do. So we had to do some technology. We had to implement some technologies that allowed us to have automated model training and use that to actually make those predictions that will work for us better in the short term. And this was especially useful in the case of spotting rising fraud trends in certain areas, right? So online delivery companies, for example, DoorDash. So we saw a lot of fraud that rose in terms of people using those delivery services, and we had to react to that on a very, very quick basis, right? So at the end of the day, 3 big things. So we went back to more raw data, right? And then we brought in more AI/ML technologies to kind of extract intelligence out of it, and a lot of automation where the learning itself is automated so that your models are more accurate even in the short term. That helps us navigate. And for a company like Amex that uses pretty much data and models to make 99% of the decision, that is very, very critical, right? It allows us to maintain the scale of the business that we do, right? So that's our story. So that's the story of the pandemic, and it's not over yet, right? So if you look at what's ahead, the uncertainties are still continuing. So you have thoughts about stagflation that's out there, and potentially it could convert into a recession. And what does that mean for the loss rates? This time, I don't think the government is going to come in and step in a way that they did before. So things might be the outcomes might be very different this time than it was the last time. So we may need to kind of take that recession playbook we have, dust it one more time, and then figure out what we need to do looking forward. That may not be the same as what we were doing looking backwards, right? So that's our story. So as you can see, we compressed a lot of things that we perhaps might have done otherwise into the space of the last 3 years because of the pandemic. It accelerated a lot of things. And I suspect that that is not over yet. In the next couple of years, it's going to be still more uncertainty, still more changes coming, and we'll have to kind of make sure that we evolve ourselves to be able to navigate through that. Okay, so I'm going to stop there. Do we have time for questions? Or okay? Thank you.